Hello, and a very happy new year to you and your family. Welcome to this special edition of Bloomberg Daybreak. Markets are closed as we ring in 2026. I'm Nathan Hager. Coming up at this hour, we're going to look at what's ahead for the sector that has led the way for the stock market the last couple of years. Big tech. 2025 was once again bullish for technology, but not without its bumps and bruises. A deep sell-off in April, followed by a powerful rally, then another sell-off of many of the biggest names in the final quarter. So, what could be in store for 2026? Who better to ask than two of the most prominent analysts on the street? Ives Munster, managing partner at Deepwater Asset Management, is with us, along with Dan Ives, global head of tech research at Wedbush Securities. For the full hour, it is great to have both of you back on what has become a semi-annual tradition here on Bloomberg Daybreak. But before we look ahead to 2026, let's look back at what both of you had to say about tech the last time we were all together here, back on the 4th of July. Gene, let's start with you. You were pretty enthusiastic.
I actually am so bullish on AI. I think that it has the power for these companies to continue to move higher over the next 3 to 5 years, despite what is going to happen, what could happen with the overall macro. And I don't like being out on a limb that far. And the right approach is that AI is just much more impactful.
Of course, Gene, that was before the rotation at the end of 2025. Are you still as enthusiastic about big tech as you were then?
Yeah, nothing has changed in that optimism. I still think we're going to see the AI trade outperform the NASDAQ for next year. I think that the NASDAQ's going to be up, call it 5, 10+%. So still optimistic, still believe I'd put it in the second inning of all this, and understand that may come across as seemingly out of touch with reality, given I think some of towards the end of the year, some of that concern that has poked its head up around the AI trade, some issues that investors have had about the amount of investment that have been made in the market at times, just shrugging off good news. But Nathan, I think that this is still intact. I think the transformation really hasn't even begun. And I think that patience will pay off when it comes to wealth creation over the next few years.
All right, I want to turn now to you, Dan, over at Wedbush. I think I have a feeling what you might say, but let's listen back to what you told us back in July.
This is a fourth industrial revolution. This tech bull market, it's another 3 years ahead. And that's why I think it's get out the popcorn, get out the champagne. I don't see anything slowing it down.
Do you see anything slowing it down since then, Dan?
No, I mean, look, I'm more bullish on the theme today than I was back in the summer. Given monetization, given what we've seen with the spend, given names like Palantir and others as the use cases are built out, and now going into robotics and autonomous, to me, look, it's 2 more years left this tech bull market. I'm not going to say we're not going to have white knuckles, as me and Gene always talk about. Mm-hmm. But nothing in any way makes me get off this AI train. To some extent, it's more emboldened.
I want to turn back to you, Gene. You say it's the second inning in the AI trade. I think in the times that we've spoken before, it's kind of been where it's been before, right? I mean, I think I've heard you say we're in the second inning for quite some time. When do we get to the third?
Well, earlier in the year, I guess at the beginning of 25, I thought we're in the third inning. And so I guess what happened to make me believe that we're in the second inning, just like to put some specifics on it. And this is what I love about this, the year end, is we can look back and just look at the kind of the arc of what's happened. At the beginning of the year, the street was looking for NVIDIA to have 18% growth for calendar 26. If you look at what they said at the end of November, this excludes anything from the H200s in China, but they're going to do somewhere around the mid 60% growth. So this is a company this is not a $1-2 billion revenue company. This is a $250-300 billion company that's seen an acceleration. And why NVIDIA, of course, is so important when it comes to kind of gauging what inning we're in, is this is the brain. Think of the hardware piece. What NVIDIA powers is the size of the brain. And when you think about this accelerating spend around the size of the brain, it makes me more optimistic that the output, and this is the critical piece, the utility that brain will kick out eventually will be more powerful, which makes me have higher confidence that we're earlier than what I thought at the beginning of the year.
I want to ask you, Dan, where you think we are in the AI race, and to talk a little bit more about NVIDIA, because just in the last few months, we've seen, I think it's safe to say, quite a bit more, at least chipping away, or at least attempts to, at NVIDIA's dominance when you think about Google's TPUs and this investment by OpenAI or by Amazon into OpenAI with its potential competitor to the NVIDIA chip. Does NVIDIA continue to keep this moat around itself that it's had over the last couple of years now in the AI chip space?
Look, I love how Gene puts it with the brain and the utility, because I think that's so true in terms of where NVIDIA plays. Look, coming back from Asia, 3 weeks there, demand to supply is 12-1 for NVIDIA chips. The reality is, Nathan, like, customers can't get enough. They have to go, whether it's AMD, whether it's Google on TPU, whether it's others. But that's not a bad thing. It speaks to our view that, like, the LLM models are going to get cheaper. You can have more competition when it comes to AI chips. But at the end of the day, NVIDIA continues to be 3 to 4 years, maybe, like, in terms ahead of competition. And that's why I think it's still a very cheap stock. 250 to 275, 2026 is where I see this stock playing out.
We're speaking with Dan Ives, Global Head of Tech Research at Wedbush Securities, and Deepwater Asset Management Managing Director Gene Munster. Gene, that's a very interesting point that Dan just made there, the idea of NVIDIA being a cheap stock, because there has been all this discussion over the last few months about the valuations of the Magnificent Seven. How do you view NVIDIA's valuation right now, along with the rest of the Mag 7? Are these still stocks that can keep getting into these sky-high valuations?
I mean, Dan's doing the right thing. I mean, he's looking beyond the appreciation that we've had and asking the question, like, what is on the come? And ultimately, that's the question, the central question we all have to answer. And I think when we get to the question about, like, valuation and where this market potentially go, it can boil down to something as simple as your view on how the utility of AI will play out. So if you take the perspective that we've had a good run and that AI is going to be impactful, but it's not going to be a total game changer, it's not going to exceed the high expectations that are out there in terms of how it's going to impact the world. If you take that approach, there's little that I think anybody could say that is going to get you optimistic about where this is ultimately going to go. If you're in the camp where you believe that these companies, Dan mentioned companies like Palantir, you think about some of the Mag 7, some of the small caps as well. If you believe that ultimately that we're still early, therefore their valuations are going to be lower in the future because they're going to have faster earnings growth. And so that's effectively what we're faced with, is this question about the degree, the pace of this and how it impacts. If you look at, Nathan, just the numbers, like let's forget about that and forget about where we're going and just look at where the stocks are. They are trading higher than normal. If you look at, for example, the Mag 7, kind of over the next 12 months, trading at around a 27 times multiple, excluding Tesla, that's as a 100 plus multiple. But so they are higher, but it's not like crazy high. As a reminder, back in 2000, the NASDAQ was trading at 100 times next 12 months. Now, the dynamic of the market's different today because these mega caps, we're not going to ever, unlikely we'll ever see that 100x. But I think it's reasonable that a 27x on what potentially could be multiple years of 15, 20% growth is positive.
Dan, how do you answer some of the critics who point out a lot of these companies, spending hundreds of billions of dollars into this technology that is then getting, or circularly invested into the companies themselves. The idea that OpenAI and others are getting all this investment from companies that are going to be benefiting from their business, like the hyperscalers.
Yeah, but I would say, and Gene and I have talked about this a bunch. I don't view this like a vendor financing, circular financing late 90s that Wedbush saw. I mean, my view is OpenAI, for every dollar that they invest, for every dollar NVIDIA invests, they're getting $10, $12, $15 back over the course of the next 5, 10 years. And that's a bet that they'll make because, look, they're building out a new economy for consumers, a new economy for enterprises. So I don't view it as sinister red flag, the circular financing concept. To some extent, I view it as like you want to be associated with OpenAI, not away from them. And even though right now those stocks are, really have a huge sort of black cloud over them, it's like, is it bad? No, it's actually good because they are at the epicenter of this AI build out.
Is it important, though, Gene, for OpenAI to turn a profit in 2026 to justify all this spending?
No, it has. I mean, this is the beauty of everything that's going on is that you have very rational people that say profit is important, and there's other rational people that say it's just about building the framework. And so the key question about this cash burn with OpenAI, we can talk about the rumored round, this $830 billion round that's rumored to be going on. But the key question ultimately is eventually, call it 2030, can they be profitable? And part of that is, to Dan's point, like, can they continue to raise money to fund this impressive expansion? And impressive expansion, I just want to put some numbers around it. It's 100% growth expected next year and the year after and the year after for the next 3 years. And so I think that when you think about the profitability question when it comes to OpenAI, like that really doesn't matter. What matters is, can they get enough financing? Can they raise enough equity to the tune of about 100 to 150 billion over the next 3 years to continue to build out to get to that profitability piece in 2030? And I think the answer is overwhelmingly yes. It's just too big of a prize. Dan and I are well aware of what's going on in the private markets. There's just a ton of investor demand to participate in this, and so they're going to be able to have the money to power through this cash burn that they're going to have for the next few years.
We're going to continue this conversation, take an even closer look at the Magnificent Seven stocks as this special New Year's Day Tech Hour continues with Gene Munster, Managing Partner at Deepwater Asset Management, and Wedbush Securities Global Head of Tech Research, Dan Ives, on the special edition of Bloomberg Daybreak for the new year. I'm Nathan Hager, and this is Bloomberg. Welcome back to the special New Year's edition of Bloomberg Daybreak. I'm Nathan Hager, and even though markets are closed on this first day of 2026, we got a high-tech power hour going. We're speaking with Dan Ives, Global Head of Tech Research at Wedbush Securities, and Gene Munster, Managing Partner at Deepwater Asset Management. Dan, let's pick up where we left off in the last segment, talking about some of the valuation, some of the financing that's going into these startups that are, possibly getting into really, really big valuations like OpenAI. Do you see that continuing when, there is still so much competition among some of these large language models that are competing with OpenAI?
Look, I'm not saying that you won't have a bubble or maybe froth in certain areas of the market over the next 12, 18 months. But to look at the core winners and to say that they're expensive and just kind of paint it with a brush, I think it's the wrong way to view it, because my view is like, look, you have 3 to 4 trillion being spent in the next few years in terms of the build out. The ripple effect, every dollar spent on NVIDIA chip, there's an $8, $10 multiplier across the rest of the tech. So investors, like, they're looking not in the next 1, 2 years, they're looking beyond that to understand who the core winners are and will they grow into valuations. I mean, it goes back to if you go back to some of the Amazon days, some of Meta, some where NVIDIA was 2021, 2022. I think that's sort of the view in terms of this transformation that we continue to believe like you only have 3% of companies in the US that have fully gone down the AI path. And for the first time globally in 30 years, the US is ahead of China when it comes to tech.
I think I heard Dan talk about the idea of winners and losers here in the large language models. Gene, how are you thinking about winners and losers right now in that space?
Well, I think that there's basically 4 or 5, depending how you count Meta as the large language models. And I think that when there's this, let me just take a step back, there is a view that ultimately it's a race to the bottom, that these companies are creating intelligence and therefore they won't, the pricing is going to go down to a level where we're going to have 5 losers, essentially. They're going to spend all this money. And our belief is that actually what you'll see is even though the pricing will come down, the value will increase to a point where the pricing, this gets back to this Jevons paradox that's been talked about for the past year or so, that yes, pricing comes down, but the value increases, therefore the usage increases, that more than offsets the decline in pricing. And so I think that all these, to different degrees, are going to be winners. One piece that is kind of like below the surface that doesn't get talked about as much is the personalities of the models. And the way we think about it is the world doesn't run on one personality. And that's what these models are. They have personalities. You ask one model, you ask 5 different models, 5 different questions, and you get slightly different answers. And so I think that there is something to be said about, this isn't a political statement, but some models lean right, some models lean left. Organizations are going to want to build on top of models that align more with their personality. And so I think that is going to create an opportunity. You're probably going to see a couple on the right and a couple on the left. And so it's hard really at this point to say, which one is the losers. I think I look at it more of the conversation about them all being losers, about this race to the bottom, misses the fundamental point, which is as value comes from the intelligence, people will pay up for it. I realize that is a bold statement, but I think that's the piece that is missing in terms of how these companies continue to, how OpenAI, for example, can be a $1.5 trillion company.
Well, that's a really interesting idea. And I wonder, Dan, if that's something that you've thought about as well, whether there could be a scenario where companies are using multiple large language models as opposed to settling on just one.
Hey, look, I think what Gene just said there is gold. Because that, to me, that summarizes the crux of everything we're seeing in terms of this AI build out, winners, losers. You could pick your OpenAI, pick your Gemini, pick, whether even in China, some of the models there. To me, it's all going to be about hyperscalers and the data that it's built on. That continues to be such a core piece of this AI revolution when you think about the hyperscalers and the infrastructure. It's about the data, the infrastructure to build out.
I want to talk about the theme that has really driven this market for the last few years. Of course, that is the Magnificent Seven, and take a look at where those stocks in particular could go in the next year. Gene, do you see the Mag 7 continuing to drive the rally, all boats lifted together in that space?
I do think the simple answer is no. I think that we're going to see some pockets. Some of them are going to outperform really well, and some of them won't perform as much. I mean, my sense is that the small cap piece is going to continue to be an important part. I want to be clear that I think you should own many of the Mag 7. I think that they're going to continue to generate a better return than just being in the Qs, for example. But I think that there is a little bit of a dynamic. When it comes to the Mag 7, the two that I'm focused most on, this wasn't your question, but I do want to highlight this, is
sure.
I'm kind of splitting hairs here in terms of how to think about the winners in the Mag 7 for calendar 26. I think Apple, I'm putting that as the top performer for the front half of the year, just because I think there's going to be multiple expansion going into the new Siri, which is code name for the new Apple Intelligence, and they land that after being, I think, more or less eviscerated over what's happened so far with AI. They land that the multiple on Apple is likely going up. So I think that Apple's going to have be the best performing Mag 7 through the first half of the year. And then if you look at the full year, I think Google is in a unique place, just given, they're really doing a great job of taking this the search traffic and starting to find ways to get people to interact with their products more, which obviously more shots on net. It's good for the revenue growth within search, and of course they've got their cloud business. And so those are the two that I would focus on most. Again, I'm not. It doesn't mean that the other ones won't do well, but I think those are the ones that will do the best.
Dan, what are you looking at in the Mag 7? Do you see winners and losers in there?
I mean, look, Gene preaching to the choir, like what he's saying about Apple, and it's been a battle because they've essentially been invisible with the AI strategy, but now with Google, when the DOJ, that clears a path for a bigger Gemini deal that comes out in the spring. And I think there's no multiple for Apple given because of AI with the biggest install base in the world. I could argue add $75 to $100 a share. So I think I agree 100%. Me and Gene, it's a very small Apple fan club. We stick together there. Okay.
All right.
And then I agree with Google, but I think Microsoft here is so oversold. Investors feel like best is in the rearview mirror. It's now about Google, Amazon. They're in the enterprise market. That's Redmond's domain. And I'm telling you, to me, that's the one that I focus on is just a table pounder here.
Interesting, because it does seem like there is a pretty more heated competition in the cloud space as well. Gene, how are you looking at that when it comes to the competition between Microsoft Azure, Google Cloud, and Amazon Web Services?
Well, I think the bar is lowest with AWS just because the growth has been lowest, and they just haven't seen that breathtaking into the 30, almost 40% growth that Azure and Google have experienced more recently, off of a bigger number because their market share is more, so it's harder to grow at those rates. But I think that this is not the cleanest answer, but I think all of them are going to do well. I think if you go back to kind of where Dan and I are at in terms of just the broader build out that's going on, if that in fact does happen, all of them are going to benefit. There's a contrarian piece in me that wants to. I like what Dan's saying about Microsoft. I agree that's a contrarian on the top pick. Therefore, it probably happens. But the contrarian piece around AWS is that they end up being kind of the surprise. I go back to they had their AWS event. The CEO of AWS said that they. I may even have his exact quote. I was just looking up this morning. On December 4th, this is Matt Garman. He said, "Demand keeps skyrocketing. We're only speeding up that infrastructure build out." So, halfway through the quarter, 2/3 of the way through the quarter, he says that it's probably a good sign for AWS.
Dan, your reaction to that?
I mean, look, I agree 100%. And I'd almost further and say, I think one of the biggest surprises as we go into 26, I think it's going to start off with Jensen's keynote at CES, which will be at, it is just about the overall demand that's accelerating across the whole universe. And I think that's something where investors, I think, are underestimating the scale and scope of what this is going to look like, and also going to have a huge impact, not just on earnings, but I think even on increased CapEx and on accelerated monetization of the AI theme going in 2026.
Gene, are these hyperscalers going to have to continue to find ways to cut costs to keep up the hundreds of billions of dollars they're spending on AI?
Well, I think I think they will try to continue to cut costs. A lot of it is because they're eating their own products. They're implementing more. Think about how much they're using, whether it's Microsoft and Meta and Google in terms of code creation today. Something like more than half is now generated by machines. So, but do they have to grow this? If you just some really high level math here, but think about the average Mag 7, excluding Tesla, is generating about $100 billion per year in free cash flow, and so they're spending, call it, That's, by the way, that 100 billion includes them spending 50, 75 billion a year on infrastructure. And so they can increase by 20, 30% and still be bringing home 50, 75 billion dollars. And so they're a long way away. And that's, I think, one of the big differences that we're experiencing today versus 25 years ago is the cash flow generation. They can just keep feeding this machine. And so inevitably, investors do care in the near term about earnings. Look what happened with Meta. Meta just said after their September quarter that next year that expenses were going to grow faster than revenue. They had very upbeat commentary about revenue, and the stock, I forget what it was, down 15, 20% over a short period. And so they do care in the near term, but the reason why I stress that near term, I think the long term, investors will have a sense like this money is going to good use, and even if they're and they've got plenty of money to continue to invest in the business. And most importantly, that's the right thing for them to do, because if they don't make those investments, obviously it poses them at some bigger existential risk longer term.
We're going to keep this conversation going on the Mag 7 and more of the big tech sector as we continue this special New Year's Day edition of Bloomberg Daybreak with a look at another big piece of the Mag 7. That would be Tesla. That's coming up. I'm Nathan Hager, and this is Bloomberg. Thanks again for being with us for this special edition of Bloomberg Daybreak. Markets are closed for the New Year's Day holiday. I'm Nathan Hager. Wrapping up our special high-tech roundtable, we have been spending the full hour with Dan Ives, Global Head of Tech Research at Wedbush Securities, and Deepwater Asset Management's Managing Partner, Gene Munster. We could keep this conversation going for the entire day, but we got to wrap this up. Starting off, guys, with a stock that I know both of you follow very closely. That would be Tesla. Both of you have made some pretty bold calls on the electric vehicle maker, but does it continue to be driven by the EVs headed into 2026? Dan?
I first off just want to say, I mean, I could listen to Gene. If I had some Sour Patch Kids and maybe a Cabernet, I could listen to him talk tech the whole day.
Yes.
Now, with that said, look, Tesla, they're entering the most important year ever. Autonomous and robotics. I believe 30 cities will have robotaxis, in 2026. And this is the year AI revolution comes to Tesla. And I think when it comes to physical AI, the two best physical AI players in the world are NVIDIA and Tesla. And I think now Musk, wartime CEO, and really is going into the next, such an important chapter in the Tesla story.
A great way to describe him as a wartime CEO, I think, Gene, because Elon Musk has been through a lot just throughout 2025 between the political moves and coming back to Tesla with the renewed focus. Where do you see Tesla going in 2026?
I think, Dan summed it up. It's about the robotaxi. It's about autonomy. I mean, those are the headlines that are going to be of most focus. There is the question, I think that's what matters most. There is a question, what happens with deliveries? I'd be curious, Dan, your take on this. I don't know if investors really care if they beat the numbers a little bit, but just for some context, this is as of a week ago, the street was looking for 16% delivery growth for calendar 26. I think it's probably going to be more like flat to up 5%, a little bit of a miss there. And again, when you start talking about some of these negative things, it misses the point. I agree with Dan's highest level, which is one of the best positioned physical AI companies, full stop. But I do wonder, I'll stand, do people care? Let's say the deliveries, let's say they miss deliveries for 2026. Does it matter?
I mean, this would be like going to Carbone in Miami for the water. The point is you're focused on autonomous and robotics. That is the focus of tech. Deliveries, look, Gene, there's a stabilization, and that's what investors want to see. Europe obviously continues to still be, very depressed. But I think as long as you see a stabilization and you're seeing that, that's fine enough. but you own the stock because of autonomous and robotics.
Indeed, I do own it. Yeah, and that's well said. I think the stabilization piece is really important. One other thing, just to kind of play it forward. So who knows? My sense is they're probably going to be a little bit too high for the, for calendar 26, but I don't think it really changes the big picture. Like when I see what Ford did at the end of 2025, basically, what was it, a $2.5 billion charge, $5.5 billion charge? These bees end up becoming all noise at some point. But the reality that they're taking this big step back, I ask a question like, if they want to participate in autonomy and they're not investing in the EV piece, are they envisioning, I don't know the answer to this, but are they envisioning a world where it's like hybrids are going to be autonomous? I think that is not the world. I think it's going to be all electric. But I think when you look at what's going to happen with the delivery numbers this year, beat them or miss them, the stabilization is really important. I love that perspective, Dan. And then the second piece is like, just look at the big picture, is that these other car makers, they're not only nowhere to be found when it comes to autonomy, but they're running towards profitability at the cost of the future.
Yeah.
I agree. The one thing I'd say is like, you look what's happening. I mean, like GM's handled a lot better than Ford, but if you look what Ford's done, they're basically thrown in the white towel. I think to some extent, to Gene's point, you're going to have to eventually see when it comes to autonomous, they're going to ultimately, I could see Tesla at a point partnering with some of the big U.S. automakers as they ultimately go down this path.
That would be an interesting idea. But I'm curious, Gene, just to go back to a call Dan made earlier about robotaxi in 30 cities. I mean, we've seen Elon Musk set deadlines and let deadlines go quite a few times over the years. Does Tesla need to expand robotaxi to that extent to keep investors satisfied?
I just love that bold call. They don't need to get there, and I guess as Dan's sense is the same. They don't need to get to that level to satisfy expectations and to move the stock higher. So it's a point of reference. They're in 2 cities today. They recently in Austin went to no safety driver, but there's also no customers in there either. And it usually takes 3 to 6 months. I've recently done some deeper work in terms of how the approval process works in terms of local municipalities up to the state level. And it is, the states play off of each other. And so to Dan's point is that they, let's say 3-6 months from now, they start to get some good feedback in terms of how they're doing without a safety driver in the car. Other cities will use that to quickly turn it on. And the beautiful thing about Tesla's model, of course, is they can turn it on in a heartbeat. I mean, they can build these cars at 30,000 a piece. That's for like a Model Y autonomous and eventually the Cybercab. And Waymo just can't do that. I mean, they've, they're at 100,000 plus.
In the time we have left with Dan Ives, Global Head of Tech Research at Wedbush Securities, and Deepwater Asset Management's Managing Partner, Gene Munster, I want to look outside the Mag 7 to some of the other big tech names that you guys follow, what we should be looking at in 2026 as we think about this sector. Dan, I'll start with you. Which companies are you really focused on in the new year to outperform?
Look, it continues to be, Massive AI, Palantir in terms of front and center on the use cases. But I think you're going to see Snowflake, MongoDB. Those are going to be some significant outperformers. I like when I look at like the infrastructure, Nebius, that continues to be a name that we're super bullish on. IREN, that's one where it's also a power play, along with GE Vernova. It's one of our favorites. I think you have to focus on the second, third, fourth derivatives. Cybersecurity, CrowdStrike's another one front and center along with Palo Alto.
Interesting, because a lot of those running into the same kind of potential criticisms in terms of valuations. I'm thinking of Palantir in particular. Gene, what do you think of some of what Dan's talking about there, and what companies are you keeping an eye on that could outperform?
I mean, it all makes sense, and his he'll forget in a day, or he just knows infinitely more on some of those companies than I know. And when I think about kind of the expectations around some of these, and I mentioned Apple and Google, the mega cap, and then it'll be kind of fun. Maybe we can play this soundbite when we join in the middle of the year how this is going. But I think that the small cap index, which we'll just use the PSCT as that, is going to outperform the Qs. And so that's kind of the sub $500 billion. Still believe you should own the mega caps, but I think you're going to see better performance from some of these small caps in 2026.
You keeping an eye on some small caps, Dan?
Look, I mean, there's a handful of small caps, specific on like cybersecurity. I think there's a number of names like Tenable, Qualys. I think there's a number of names like on the power side that could be super interesting. Names on the software side like Hager Systems. Look, I think you look at, like as Gene said, second, third, fourth derivatives across AI. That's where I think some of these gold maybe at the end of the rainbow could be.
Interesting. So does that point to the idea that we could see something of a rotation like there's been a debate on in the broader market within big tech, maybe a rotation or a broadening away from the Magnificent Seven names into more of the tech space, Dan? Is that something you're thinking about?
I think it's a broadening out, but it's still going to be led by big tech and led by the core AI revolution names, but it spreads to second, third, fourth derivative, and you're going to see that spreading out. And I could argue even you're going to have an AI ripple effect to financials or healthcare, a broadening of the market. But do remember, tech's in the left lane 100 miles an hour in a Ferrari. I'd rather have that. Yeah, you'll get some speeding tickets rather than being in value in the right lane 45 miles an hour with a bumper sticker saying my kid was an honor student in third grade.
So still with a very bullish call on the tech sector. Gene, where are you when it comes to that kind of thinking about big tech in 2026?
I'm still just thinking about that bumper sticker, big tech in 2026. Yeah. I think that it's, I think you should own some big tech. And I mean, will kind of make some fun. I mean, Dan and I are on the exact same page at the bigger picture here. There's a little nuance that I have related to some of the small cap, and we'll see how PSCT does relative to the Qs. And companies, smaller ones, smaller in quotes, $150 billion Arista networks or Vertiv on the power cooling side. I mean, these companies have had just breathtaking moves, but if we're right on the bigger picture here of how much infrastructure is going to be put into place, those companies like that should do well. And I think that's going to be a positive for the small cap trade.
And Nathan, I would also just say, I just keep trying to figure out, besides the AI revolution, how do we get Gene to wear a pink sports jacket? That's something that we have to figure that out.
Well, we should. We need to come up with some like market number. Then people will say, well, that's going to be the peak of the market, but I'll purchase a pink sport coat at. We'll figure out that number, Dan, and be back to you, Nathan.
If Dan Ives and Gene Munster switch wardrobes, we will know that we have gotten somewhere in the tech trade.
I don't think you'd recognize either of us, but
seriously. Not to end this on a downer, but just quickly, before we let you guys go, what should investors avoid like the plague in the tech space in 2026? Gene Munster, just quickly.
Well, I guess I'm just so optimistic about how early we are. I'm reluctant to pick kind of avoid like the plague. I think we'll see how this plays out when the companies go vertical and in short amounts of time, then we could maybe have a valuation, but I just don't have anything on my list.
All right. Well, we'll end it there now. But again, always a pleasure getting you guys together this time of the year.
Right on.
That's Gene Munster, managing partner at Deepwater Asset Management, and Dan Ives, global head of tech research at Wedbush Securities. Thanks to both of you for spending the entire hour with us. And thanks to you as well for ringing in part of your new year with us. I'm Nathan Hager, wishing you many happy returns, tech or otherwise, in 2026. Stay with us. Top stories, global business headlines coming up right now.